All right, good morning and welcome back to the Money Advantage podcast. Bruce, I'm really excited to talk with you today because we're talking about a concept that is very familiar to most people who are trying to really make their financial life work well. And this is called diversification. This is a topic that if you're an investor, if you've been in the investor space for any length of time, even if you are just investing through a 401k, you're hearing this term. And usually the typical way of thinking or the typical advice, the status quo way of thinking about diversification is that it is a method of not having all your eggs in one basket, meaning one basket tips over, one basket is stolen, and you still have other baskets or you still have money in other baskets that is performing for you. And ultimately, this this is targeting the idea of hedging risk or minimizing risk because they say, well, if you have all of your investments in one place, then you're liable to have that one. If something attacks or corrupts or steals from or limits that one egg basket, then you're out a complete strategy. And so we're going to talk about diversification probably from a different lens than you've heard of before, as we are really on this show looking to give you practical education for how to keep and control more of your money, how to be in a position of financial control. And so we're talking about diversification from a different perspective. We're going to talk about the benefits, but also the limitations of that typical way of thinking about diversification. We're going to talk today about what is probably the more important kind of diversification that you're not even hearing about in the typical strategies that you should be tuning your ear to because this is going to be an indicator for the long-term success of your financial flourishing. And then we're going to talk about really what kind of diversification is necessary in terms of income streams rather than just looking at still staying within one market sector or one investment asset class and diversifying within that. So, Bruce, I'm really excited for this show today to just provide a lot of clarity for people who are trying to make good financial decisions.
Yeah, so let's start off by saying none of this is investment advice or tax advice. You must actually have a professional look at your situation, your financial picture, both on the investment side and on the tax side. However, um, this word diversification has been thrown around for 45 years, ever since 1979, where the 401k was started. The idea of diversification is, like as you said, not to put all your eggs in one basket. And but as we have gotten more sophisticated with our investing, um, what has happened is the analysts have said, this diversification needs to be through a lot of different stocks, bonds, and mutual funds, and now ETF, exchange traded funds. But what people don't realize is from our analysis is that many of the diversification strategies are actually holding the exact same stocks, bonds, and in their mutual fund and exchange traded funds. And then to make matters even worse, diversification did not even work in 2008 because bonds and securities, which includes stocks and exchange traded funds and mutual funds, all went down at the same time, and some commodities actually went down at the same time. And so then people started to say, well, we need to look at this differently. How do we look at this differently? Well, the first thing you need to know is where you came from to actually figure out where you've been. So if you look at diversification from the lens of 45 years ago, people were looking at it when the United States had very little debt relative to its GDP. And so we were at a time of high inflation. And when we were at a hot time at high inflation and then a relatively low stock market, because a lot of people did not get into it. And then Ronald Reagan, with the help of the Fed, actually drove down interest rates. That actually made bonds more valuable because the bonds that were higher were worth more as the interest rates went down. And equities took off because more people were putting money into the stock market, and they actually took off at that time. Inflation was driven down, taxes were driven down. So this actually also helped equities take off because the corporations were under less tax burden. And that continued along until the 2000s. And I mean, we had some recessions. We had Black Monday in 1987. We had some recessionary time periods in the 90s, but it really, really hurt in throughout the 2000s because in 2001 we had the dot-com crash. In 2008 we had the mortgage crisis, and the 2000s were called the lost decade because the S&P 500 returned less than a percentage point. And then when you conclude fees, you could say it was basically flat. And so when people think of diversification, all they're doing, I believe, is parroting what other people say about, oh, that makes perfect sense. And on the surface, it does make perfect sense. But when you dig into it, you really have to look at what does diversification do for you? And it doesn't get you the kind of security that a person might think.
Yeah, Bruce, I think it's really important to look at historically what has happened, because I think often what happens as you were talking about the difference between diversifying, still staying within really the market. You're still staying within one category of stocks, bonds, mutual funds, and the challenge is when you see systemic risk, when you see the whole market turn down, and when you see the whole landscape of the economic challenges that happen when interest rates come down, when bonds aren't as performing as solidly as you would expect them to, you're in a position where all of what people had was being lost. And really, what's interesting about this whole concept is that if you look at some of the smartest investors, and I mean, I'm talking about Robert Kiyosaki, I'm talking about Warren Buffett, you see that they don't necessarily adopt the same strategy of diversification. But why is that? So Warren Buffett says diversification is protection against ignorance. It makes little sense if you know what you're doing. Well, he knows what he's doing, and that's why he's not diversifying, because he knows and controls certain asset classes. He's in a controlling position. He's not just putting his money in a bunch of different buckets in someone else's control and hoping that they manage that well. I believe it was Robert Kiyosaki. I was trying to find in my notes that he called diversification diversification. Was it? Are you familiar with that term, Bruce?
Now, I've heard the term before, but I do not know who it's attributed to.
I'll have to double check that. But that term is usually meaning that if you put money in a bunch of different places, you're limiting the good that you could get if you invested with focus in one thing that you really knew and controlled. And so just putting those two concepts together, I mean, if you are saying, well, I don't really know what I'm doing in investing, I don't really know which stocks are going to go up or down, I don't really know what the stock market's doing, I don't really understand economic factors, I'm just going to diversify in order to not have my whole portfolio go down, you're in a position where you're not gaining an advantage by that kind of diversification. So what I think is really important to recognize is that you really do have multiple asset classes. It's not just about staying within the stock market or even stocks and bonds and diversifying across high risk, high cap, low cap stocks, or high risk or low risk. It's not just about staying within one asset class and having a diversification strategy within that one asset class. It's really about looking across the board where you have asset classes of businesses, you have real estate, you have paper assets, you have commodities, and there is much more to investing than just staying with paper assets where most people are diversifying within that one asset class.
Yeah, and you could also include, cash being a class that a lot of people will say that, if you're just in cash right now, you're actually going backwards because of inflation. And that would be true. That is absolutely true, except maybe going backwards by sitting on cash now will actually benefit by taking the, you will actually benefit more in the future by taking advantage of opportunities because you have cash. So you'll overcome that going backwards. The other thing that people do not concentrate on, I believe, and because I see it every day, is tax diversification.
Yes.
And I would like to just read a little bit from the Washington Post today. This article was October 8th of 2024. And here are some
Yesterday.
number, yes, as we talk today, yes.
Hmm.
And it says the federal budget deficit swelled to $1.8 trillion in the fiscal year that ended in September. So that what that means is that the federal government spent $1.8 trillion more than they had revenue coming in. So it was added to the already um, the debt. So deficit is actually what you see during the year, and then you add the deficit by borrowing costs to the debt, and that current debt is $35.7 trillion dollars. And what is really difficult to understand right now is that we have had some close uh, debt to GDP ratios in times of war, times of bad situations in our country, but we have actually swelled the debt in times of economic prosperity since
Right
the
now.
2008 crisis. We've had relatively good economic prosperity, not only in the markets, but in the overall economy. Unemployment over that time period was very, very low. And so this is a really big problem when we are adding to the deficit, yearly deficit that then adds to the debt. So here's an interesting thing that the interest payments on the debt have now reached $950 billion per year, and that is larger than the Pentagon budget, the defense budget. So just the debt that we're paying. And they're saying that the next president is likely to face key decisions along with Congress to tackle these debt and skyrocketing interest costs. As then he starts to talk about the different candidates' views on this, and then there's um, there's there's a lot of debate on which candidate is going to actually help solve this. But the one thing that is true is both candidates are going to continue to add to the deficit.
Hmm.
And then that will add to the debt every year. And if you add that to the debt every year, you're going to have increased interest rates.
Hmm.
And then, or sorry, excuse me, interest cost every year. And it's just like anything else of a family budget. If most of your interest, or excuse me, most of your capital is going to interest payments, you don't have that capital then going to improve your family with other investments in your family. So the same thing is going to happen in the United States or any country that runs this kind of debt is the interest payments that are going to just service the debt could have been going to other things to enhance the country.
Hmm.
And this is going to stagnate the country in that way. Plus, the 2017 Tax and Jobs Act is going to expire without any congressional change in January 1st. Well, expires on December 31st, 2025. So a little over 15 months from now.
Hmm.
Excuse me, a little less than 15 months from now. And then what'll happen is taxes are going to go back up, and they're not going to go back up enough to even slow down by very much this increase of deficit, adding to the debt. So then, what is Congress going to do to try to do this? Are they going to continue to raise taxes? Well, if you raise taxes, then that's raised on also corporations. Corporations then are not going to make as much money. They don't make as much money. Profits will then go down, profits go down, equity prices go down. So
Bruce,
this is a spiral that
yeah.
people have to take in consideration.
Bruce, I was actually reading some similar numbers or same numbers this morning. I was reading just a recap from the Morning Brew, so I'm sure they were pulling from a lot of the other pieces of data. But one of the things that I just thought was so fascinating was that they said the U.S. spent 950 billion on its IOUs last year, and it's at a 34% spike from the previous year. And I think we're so used to hearing about debt and deficit in terms of trillions of dollars that I feel like we are almost becoming desensitized as an American
Absolutely.
population to these gigantic numbers that are so astronomical that we can't even wrap our brains around it. But when you look at things like a 34% spike from the previous year, I mean, it's an exponential curve going in the wrong direction. I mean, it's an exponential growth of deficit and debt. And they also had mentioned, similar to the point that you made, that usually you see those deficit and debt spikes during hardship times. We saw that in a time of economic prosperity for the most part in the US. And it said during the economic boom times of the early 90s, federal debt was 1/3 of the US GDP. And fast forward to 2027, they're predicting and projecting for debt to top 106% of GDP, which is insane. That's over the production, which, I mean, if any household ran their income that way, you would be in a position of financial bondage. And so when you look at that, I mean, that's the same situation that the American um, economy is facing.
Yeah. So then, as you talk to people about this, then people, the first thing they say, well, what should I be doing then?
Hmm.
And you already outlined a little bit about that as far as diversification, not only over asset classes, but only investing what you know so that you don't have to take into consideration losses. And that's what the diversification, you're admitting that you're going to lose in one area and gain in another area so that you have an average. So if you can actually work in an area that you know and understand so that you have the best chance of just reaping the benefits and minimizing the losses, then you'll come out ahead. But the place that most people um, fail to plan for is tax diversification.
Yes.
And we don't know where taxes are going in the future. Nobody has a crystal ball, just like people don't know have a crystal ball on investing. However, we do know if there's not a change, the tax rates are going to go up. We do know that, as you said, we're over 100% of GDP ratio to our debts. And so and by the way, we didn't even talk about Social Security and Medicare being severely underfunded in the middle of the next decade. And so,
Which means people who are counting on that check to come to them, it's less likely that you can depend on having that income stream, that dollar amount that's listed as what you're supposed to be getting.
correct, the projections are you'll only receive about 75% of it. And so, how does all this get solved? Well, I don't know if we have the ability to solve it, but we have ability to actually try to lessen the effects of taxes by getting more money into tax advantage places or taxable places where there's only capital gains costs instead of ordinary income costs. Now, you do not want to completely eliminate ordinary income because under current tax law, unless they change it, you do have the ability, to, under current tax law, to take off some standard deduction or itemized deduction. So if you have business income or you have income from tax deferred, you can offset that. And that would be really, really nice. You then take a tax deferred, not pay taxes when you defer, and then not take taxes when you pay taxes when you take it out.
Mm-hmm.
The other possibility is taking some of that tax deferred or a great amount of that tax deferred and convert it into a Roth IRA so that it grows tax free. You must pay the taxes at this time. However, there are ways to do tax mitigation to actually eliminate the taxes in the year that you do the conversion with proper look at your total portfolio, or at least to minimize it, and then get it into a tax-free position. A lot of people don't want to do that because they're like, well, but I'm paying all these taxes now. Well, that is true, but if you think about the projections in 10, 12, 15 years from now, or you're passing that tax deferred money into the future to your next of kin, who the Secure Act 2.0 now says they have to pay the taxes over a 10-year period instead of your lifetime, then if you're trying to do what's best for your overall legacy, then paying the taxes now strategically instead of into the future with your heirs makes much more sense from an economic tax diversification standpoint.
Bruce, I think there's a couple points that you're making here that I just want to accentuate because I think they're so critical. And one of them is if we boil all of the economic factors down that we were just talking about with the national debt and the deficit and GDP and the ratios and what's happening in the stock market, what's happening in interest rates, what can happen with bonds, if we look at all of that and take that all into consideration, really the big picture is that if there is a much greater need for tax income from the if the US government has a much greater need for tax revenue to be able to pay for the debt and the deficit and the interest on all of that, then we look at a situation where, again, we're not predicting, we're not projecting that this is going to happen, but it seems for all intents and purposes that taxes are going up in the future. If your number one investment strategy is to defer taxes, and that means you're not paying today, you will pay in the future, you're putting your investment dollars in a position where you have an unknown future tax burden. And we know that for certain. It's an unknown future tax burden that you're putting on yourself and your children. And what can be done instead is to look long term. And every time you look long term, you make decisions today that might hurt a little bit now, but they're going to be best for the future. It's the same thing with the marshmallow experiment with the children where they said you can have one
Right.
marshmallow now, or if you wait, you can have two marshmallows. Well, it doesn't feel nice to have to delay gratification and to ignore that thing that you really want right now, which might be to not pay taxes today. But if you're willing to take the hit today, do the hard thing today, you're going to have a much better benefit in the future. And so, what Bruce is really just saying is that we want to take taxes as a large consideration in how we're making decisions across our financial portfolio because you don't want to be in a position that everything you're choosing to invest in and put your money in today is going to have an unknown future tax burden. We want to make sure that we're balancing that risk in terms of making sure that you're paying the taxes today, even if that feels like a big hit today, it's going to feel much less when we take the hit today rather than pushing it out into the future when the hit could be much larger.
Yeah. I want to just acknowledge some comments on YouTube. Rob was talking about Buffett buying businesses that have strong financial positions
Mm-hmm.
at a reasonable valuation. And it's not the same as buying stocks and mutual funds. And that's absolutely true. Buffett looks at his investing as investing in businesses, not the stock valuation. Um, and so that's why he looks at the business valuation as being very, very important. Um, People dismiss the the reasonable valuations because they're looking at the speculative nature of hitting home runs all the time. I didn't finish my thought earlier, but the mutual funds and ETFs that are supposedly getting you the diversification that people tout, when you do the analysis, oftentimes, whether it's and I'm not going to mention the specific mutual fund, I don't want to do that, but these different investment companies, X, Y, Z, and people are saying, well, I have a mutual fund from X, I have a mutual fund from Y, a mutual fund from Z. And they said, so I got diversification not only in the mutual fund, but I have diversification because I have several different mutual funds. Same way with ETFs, exchange traded funds. The difference is one comes from an investment company and you have to redeem the mutual fund at the investment company. That's mutual funds. ETFs are actually traded on the stock exchange and you actually have liquidity throughout the day. So, and they normally have lower costs because they don't have the same type of money manager buying and selling out of those. But both of those are touted to be diversification by themselves, and then people say, "I'm going to buy several of these to get even more about diversification." However, when you do the analysis of the companies that are owned inside those mutual funds and inside those ETFs, they're buying the same companies, the same stocks within that. And I've seen it on our analysis to be 85 to 90% will
Mm.
be the exact same stocks within those mutual funds. And so there isn't much diversification when you're buying X, Y, and Z mutual fund or ETF, and you're thinking that you're getting even more diversification. And then finally, Andre says, "But what worked in the past will not work in the future." And Andre, that's that's actually the purpose of this podcast today. Thank you for reiterating that. Um, people have talked about buy and hold in the past. That has worked, but now we add buy, hold, and hope that what worked in the past is going to work in the future. But if you really look at what's going on, you're going to know what to do. And what to do is to actually work on your investment knowledge across a bunch of different asset classes. Even though people tell you not to sit on cash until you're comfortable deploying it. That will give you the best advantages from your cash that you're sitting on. And then consider tax diversification through all the tax codes that you can use, and consider if you can invest in a business, your own business. Because if you can invest in a business, your own business, you can actually pivot. You have say in the business, not just as a shareholder in other businesses. So that we think will give you the best chance to get through this time period.
Absolutely. I think Robert Kiyosaki said, when your financial knowledge goes up, your risk goes down. And that's what we're talking about. We're talking about increasing your knowledge, and even just take a look at what you're diversifying within. If you want to do the analysis yourself, you can just go look at what your statements are, what your mutual funds are holding, and you can look for yourself and find out what kind of diversification you truly have. So don't just take our word for it. Bruce, I think there's another piece of this puzzle that you've touched on a little bit by being an owner, not just a shareholder in a company, and having a controlling interest in that company so you have the ability to be more in control. But Bruce, we talk about income stream diversification as well. Can you talk more about what it means to not just have one income source, but to have multiple streams of income in order to be in a position of financial control?
Yeah, many people that we talk to say, "Yeah, I would like to keep my own W-2 and then have a side business." But other people say, "I don't have time to have a side business because of my family." Well, there are private partnerships outside of the stock market that you can actually invest in and not only get income streams along the way, but you can also get appreciation when that business or a piece of real estate is sold. So you can get into real estate, get the income stream of that, and then when that real estate is sold, you can get the appreciation that you may see in the stock market, but you're outside the stock market. Now, there's some limitations on these because they are illiquid, but that's actually a good thing. If you do your research, um, lack of liquidity in anybody's life can actually be a good thing to hit the pause button in the times of when everybody else is panic. You can't get out of it. That's really good because now the partnership has taken a long-term look at this through every economic cycle. There's also private lending, there's also private equity, there's a lot of other things that people can look into as another portion of their investing that produces income along the way. And if you produce income along the way, rather than just relying on appreciation, then that income can actually grow your net worth also. And then eventually, if you choose to retire, then that you're going to turn that appreciation pile of cash into income in some way or during and along retirement. Most of the time, it's just selling off portions of your equity to produce the income. There are dividend paying stocks and so on and so forth, but they are subjected to the open markets also. So That is something to take in consideration. And they oftentimes get you tax diversification at the same time. So you're getting anytime you put money anywhere, you need to look at safety, liquidity, and growth. You can't get all three in any place you put your money. But when you're looking at a income stream outside of the stock market, it's not technically safe, but it is safer from the volatility of the stock market. And the reason it's safer is because you don't have the same type of liquidity. So it's not liquid. Now, and traditionally, it does grow, just like traditionally the stock market has grown over a long period of time. I always tell people though, when you look at the stock market and people say, well, over 100 years, it grows this much. And I'm saying, well, but is your life of investing going to be 100 years? It might only be 30 years. It might only be 20 years, the distribution stage. And there have been plenty of cases over short periods of time that the returns have not been very good. And so you don't care what the entire time period is. You only care the time period that you're going to be using it. And as I think it was, let's see real quickly. As Andre said, what works in the past may not necessarily work into the future.
Bruce, I think there's so many threads that we could pull from this, but one that you should really take away from this conversation today is that you need to diversify your tax position of your assets. Another is diversify across asset classes. What Bruce was just talking about was in the space of alternative investments or non-correlated investments. So you're not connected to just the ups and downs of the market. Another way that you can diversify is outside of just paper assets, meaning that you're holding physical, tangible assets that keep value. So things like real estate or commodities or something like precious metals that are a physical asset that cannot completely lose value. Of course, they still do have volatility. They can still go up and down in value, but you're not in a position where it can completely evaporate or go negative because you still have a physical asset that can be sold and is valuable. So all of this is intended to help you to think more broadly in a bigger scope or bigger spectrum than just what you might have typically been told that you're hearing from all of the typical financial sources. And so it's not just about diversification. It really is about knowledge, control, focusing on what you know and control, increasing your financial knowledge, and true diversification across tax positioning and across asset classes.
Very good. And I would just like to say, to wrap up my points today, is that you, with help of professionals, I'm not saying you shouldn't use professionals because it can shorten your learning curve,
Mm-hmm.
but you must take responsibility for your learning from these people. You will be your best financial advisor because the financial advisor can give you this information. They can help you find these different things for you, but they cannot ultimately help you make. I'm sorry, they can help you, but they cannot make the decision for you based upon your risk tolerance and based upon your knowledge.
Absolutely. So we'll just wrap up by thanking you for being on this podcast, listening to the show live today. We have another comment from Jay Vagabond. Sorry, I didn't get back to you guys. And so thank you for just responding on your personal situation. So if you are in a situation where you are listening and you're wanting to make different financial choices, you can do that. You can take whatever your financial situation is right now, your current financial picture, and you can make it better by being in a position of education and then by coming and talking to our financial team and saying, here's what I have to work with right now. Here's my goals. Here's my limitations. And here's what I want to accomplish. And we can help you to expand what you're currently doing and improve and optimize your financial economy. Thank you so much again, Rob, Brayton, and Andre, for your comments. And yes, Rob, thank you for that comment about a contractor, for example, is an all-in on investment in their business. So you're in a position where when you are taking ownership and control, whether it's in your business, whether it's in your investing, that you're all in because you are you're taking personal responsibility for the direction that something goes rather than just spreading the risk and hoping it all works out. So, in closing, if you would like to talk with our team, you can go to themoneyadvantage.com. You can book a call on our advisor calendar and have a conversation about your financial life and how to improve that, how to truly be in a better in a tax diversified and asset diversified position, how to prepare your family so that you can create generational wealth. We'd love to be a part of that conversation. So in closing, remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.